So the Orion spacecraft just splashed down from the moon, actual astronauts, actual lunar orbit, and there's one company that built that capsule, the same company that just locked in a $4.7 billion missile contract on the exact same day. Welcome to Charged Alpha, episode 136. I'm Hudson Thomas.
And I'm Lana Chen. That company is Lockheed Martin, ticker LMT. And they're having one of those weeks where the headlines keep stacking. We're going to unpack every layer today.
Defense spending is surging, geopolitics are front-page news, and this company sits right at the intersection of all of it. Let's get into it. So for anyone who doesn't know, Lockheed Martin is the world's largest defense contractor. We're talking about a company that was founded back in 1912, headquartered in Bethesda, Maryland, with roughly 123,000 employees. They essentially make the weapons, aircraft, and space systems that the United States and its allies depend on.
And the business breaks down into 4 segments. Aeronautics is the big one at 40% of revenue. That's where the F-35 Lightning II lives, the largest program in history. Then you've got rotary and mission systems at 23%, missiles and fire control at 19%, and space at 17%.
The F-35 alone is a generational franchise. Over 1,000 aircraft delivered across 18 partner nations, and the program is still ramping. But what makes LMT interesting right now, in April 2026, is the convergence of catalysts.
Exactly. The Artemis II mission just demonstrated that Lockheed's Orion capsule can get astronauts to lunar orbit and back safely. On the same day, April 10th, they secured that massive PAC-3 missile segment enhancement production contract. And a week before that, they announced they're tripling their venture capital fund to $1 billion, targeting quantum computing and artificial intelligence.
The moat here is real too. These aren't products you can just replicate. Government qualification processes take years, sometimes decades. Once you're the prime contractor on a platform like the F-35, the switching costs are enormous. Nobody's building a competing 5th-generation fighter and saying, hey, Pentagon, try ours instead.
That lock-in extends across all their segments. Missile defense, satellite systems, nuclear deterrence. These are multi-decade commitments with the customer. Lockheed doesn't just have a moat, they have a moat surrounded by classified clearance requirements.
The guy running the show is Jim Teichlet. He's been CEO since June 2020, so about 6 years now. His background is fascinating. Air Force Academy graduate, combat pilot with over 5,000 flying hours, including Desert Shield during the Gulf War.
What's interesting is that he didn't come straight from defense. He ran American Tower, one of the largest global REITs in communications infrastructure, for 17 years. So he understands both the military side and how to build scalable technology platforms. That dual perspective has shaped his whole strategy at Lockheed.
His big push has been what he calls integrated deterrence, the idea that next-generation defense isn't just about building faster jets, it's about connecting everything with AI, autonomy, and open systems architecture. Basically, he wants Lockheed to be the defense industry's technology platform, not just its biggest contractor.
Let's talk financials. LMT is trading at $619.69 as of today, giving it a market cap of about $143 billion. The trailing PE sits at 29, forward PE at 21.3. That forward number is more relevant because Consensus expects meaningful earnings growth from here.
Revenue for full year 2025 came in at $75 billion, up 6% year over year, and their guidance for 2026 is $77.5 to $80 billion, so roughly 5% growth at the midpoint.
Quarterly revenue tells a nice story. Q1 2025 was $18 billion, Q2 was $18.2, Q3 picked up to $18.6, and Q4 surged to $20.3 billion. That Q4 acceleration is exactly what you want to see heading into a year with higher guidance.
What about margins? Defense companies aren't known for fat margins.
Right? And that's by design. Gross margin is about 10.2%, operating margin 10.3%. These are cost plus and fixed price government contracts, so the margin structure is inherently constrained. But what matters more is the cash generation. Operating cash flow was $8.6 billion in 2025, and free cash flow came in at $6.9 billion. That's real money.
The balance sheet looks manageable too.
$4.1 billion in cash against $20.5 billion in total debt. The leverage ratio is fine for a company with this kind of revenue visibility. They're paying a 2.2% dividend yield, which isn't spectacular, but it's consistent. And the beta is just 0.27. This is one of the least volatile large-cap stocks you can own.
So it's basically a bond with upside.
That's a fair characterization in terms of the risk profile. Overall, Lockheed Martin's financial health is solid. The revenue trajectory is positive, cash generation is strong, and the balance sheet supports continued investment, though the reduced free cash flow guidance for 2026 bears watching.
So what are the analysts saying?
The consensus is hold across 21 analysts covering the stock. 6 have it at buy, 14 at hold, and 1 at sell. The average price target is $634.74, which implies about 2.5% upside from current levels. The range goes from $517 on the low end to $756 on the high end.
That's a pretty wide spread. Who's on the bullish end?
JP Morgan has an overweight rating with a 756 target. They're clearly the most bullish of the bunch. On the other side, Bernstein is at market perform with a 600 target, and Morgan Stanley is equal weight at 635.
Last earnings was a beat, right?
Q4 2025 reported January 29th. Revenue came in at $20.3 billion, beating estimates. EPS was $5.80, also a beat. And management raised the 2026 outlook, $77.5 to $80 billion in sales, with EPS guidance of $29.35 to $30.25. The kicker was the record backlog of $194 billion, which gives them roughly 2.5 years of revenue visibility.
And Q1 2026 earnings are coming up on April 23rd, 9 days from now. So there's a catalyst sitting right there on the calendar. All right, let's lay out the bull case. The biggest near-term catalyst is the F-35 TR-3 combat certification, expected around mid-2026. If that hits on schedule, it unlocks the next phase of deliveries and sustainment revenue for what is already the largest defense program in history. That alone could re-rate the stock.
And then there's the PAC-3 story. That $4.7 billion contract signed on April 10th will triple annual missile production from 600 to 2,000 units over 7 years. This isn't speculative demand. NATO nations are committing to 3% GDP defense spending, and they need these interceptors now.
On top of that, you've got the macro tailwind. The proposed defense budget targets $1.5 trillion by 2027, up from $901 billion in fiscal 2026. When the pie gets bigger, the biggest contractor gets the biggest slice. And that $194 billion backlog is the most visible revenue pipeline in the entire S&P 500.
Now for the bear case. The first concern is the cash flow guidance cut. Management reduced FY26 free cash flow guidance to $6 to $6.8 billion, which is below what the street was modeling. That signals some operational friction, and cash flow is what ultimately funds the dividend and buybacks.
That's a real flag.
Second, the missile segment has an aggressive 25% growth target that depends on ramping production across 5 new facilities simultaneously. If any of those ramps hit delays, it flows straight to the bottom line. Third, the F-35 program has had software delivery complications that persisted through 2024 and 2025. Management says they're recovering, but surprise setbacks here would pressure aeronautics margins.
And then there's the wild card.
Right, classified programs. There's an undisclosed aeronautics effort, likely next generation, that carries inherent design and integration risk. A surprise charge on a classified program is probably the single most likely catalyst for a sharp pullback, and by definition, we can't see it coming.
So how does LMT stack up against the other defense primes?
3 main peers to look at. Raytheon Technologies, ticker RTX, is trading at 41 times earnings with 12% revenue growth. They command the highest multiple in the group, partly because of their $268 billion backlog and strong organic growth story.
So RTX is the growth premium play.
Exactly. Then you've got Northrop Grumman, NOC, At roughly 32 times earnings, with 7% growth, they have a $78 billion backlog and about 11% operating margins, which trails LMT slightly on both metrics. And General Dynamics, GD, at 22.65 times earnings, is the deep value option in the group. They're cheapest on a PE basis, despite strong positioning in combat systems and business aviation.
So LMT at 29 times sits in the middle, more expensive than GD, cheaper than RTX, and roughly in line with the sector.
That's the right read. The question is whether LMT deserves a premium to its own historical average. The 10-year median PE is around 18.5 times. At 29 times trailing, you're paying about 60% above the historical norm, which means a lot of good news is already priced in.
What's the options market telling us?
The put-call ratio is 0.66, which leans bullish, more call activity than put activity. But the implied volatility percentile is at 87, meaning current IV is higher than 87% of the last 12 months. That's elevated. Traders are pricing in a meaningful move, probably around 4 to 5%, which makes sense with earnings 9 days out.
Where's the open interest clustering?
On the call side, you've got clusters at the 640, 660, and 700 strikes. On the put side, the hedging concentrates at 580, 560, and 540. That asymmetry suggests the market is more interested in upside positioning than downside protection. But the elevated IV means nobody's complacent.
What are the insiders doing?
This one's notable. 0 insider purchases in the past 12 months. 3 executives have sold, including Missiles and Fire Control President Timothy Cahill, who sold 4,600 shares in March. The transaction sizes are modest relative to total holdings, but the complete absence of buying at a company this well-positioned does raise an eyebrow.
It doesn't necessarily mean they're bearish. Executives sell for all kinds of personal reasons, but you'd love to see at least one executive putting their own money to work at these levels.
Agreed. The selling pattern is more consistent, with executives viewing the stock as fully valued rather than significantly undervalued.
What should investors be watching most closely from here?
Number 1 is the Q1 2026 earnings call on April 23rd. Cash flow guidance is the key metric. If management reaffirms or raises free cash flow expectations, that removes the biggest overhang. If they cut again, the stock is going to have a tough day.
And beyond earnings?
The F-35 TR-3 certification timeline is critical. Any delay beyond mid-2026 would signal ongoing technical issues and could push meaningful revenue recognition into 2027. Also watch the missiles segment margin trajectory. That 25% production ramp needs to show up in the numbers, not just the press releases. And keep an eye on the broader defense budget negotiations. $1.5 trillion is proposed, but it needs to survive Congress.
All right, Lana, pull it all together for us.
Lockheed Martin is a world-class defense franchise operating at peak relevance. Record backlog, bipartisan defense spending tailwinds, and a CEO who's modernizing the company for an AI-driven future. The fundamentals are strong, but the stock at 29 times trailing earnings is pricing in a lot of that strength already. The cash flow guidance cut is a real flag, and execution risk on the production ramps is non-trivial.
So it's a great company where the question is really about valuation.
Exactly. The key metric to watch from here is free cash flow conversion. If Lockheed can prove it can grow the top line and convert that growth into cash at historical rates, the premium is justified. If cash flow disappoints again, the multiple compresses. It's that simple.
I love this one. John Clark, Lockheed's Senior VP of Technology and Strategic Innovation, said, AI will be the mainstream fabric of everything we do going forward.
That's a big statement from a company that's been building fighter jets for 114 years. It tells you where the industry is heading and that Lockheed isn't waiting around for someone else to lead that transition.
That's going to do it for episode 136 of Charged Alpha. Lockheed Martin, a defense titan navigating the shift from hardware dominance to technology platform. If you want to dig deeper into any of the numbers we covered today, the valuation, the peer comps, the cash flow picture, everything we used to build this episode is available for free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.